Gold prices leapt on Friday, adding 1.4% for the week in dollar terms and hitting fresh record highs in euros and UK pounds, as stronger than expected US jobs data sent world stock markets lower, drove the greenback up to new multi-year highs, and raised the cost of borrowing for governments everywhere. Contrary to Wednesday's private sector ADP Payrolls estimate, jobs growth in the world's largest economy leapt past analyst forecasts for December, beating consensus by 60% and pushing the unemployment rate down by 0.1 points from November's three-year high of 4.2%. Betting on US interest rates, already hawkish after yesterday's minutes from the Federal Reserve's December rate cut, said some officials wanted to pause, pushed back expectations for the next Fed rate cut from May to June. Global stock markets extended this week's drop, losing 0.9% from last Friday's finish on the MSCI World Index and taking it back down to what was a new all-time high in September. Yet despite boosting the dollar's trade-weighted DXY currency index to a 26-month high, the US jobs estimate's initial smack to gold prices was quickly reversed, with spot bullion then leaping to four-week highs above $2,693 per troy ounce. That sent gold priced in euros surging to €2,625, higher by 0.6% than mid-November's post-US election record, while the UK gold price in pounds per ounce hit £2,200, almost one-fifth higher from 9 weeks ago, and 5.6% higher for 2025 so far. Bond vigilantes are back because of consistently stronger than expected US economic data, the fact that inflation will be sticky, and also renewed focus on debt and deficits, says Mohammed El-Arian, chief economic advisor at German financial giant Allianz. The pressure on bond markets could persist, particularly in the UK, in the absence of corrective budget measures and/or if inflation remains persistent, says French investment bank Natixis, pointing to the concomitant fall in sterling in response to likely sales of UK bonds by foreign holders. The UK's 30-year gilt yield today rose through 5.50% per annum, the highest since 2008, as the pound sank for the fourth session, running to new 14-month lows against the rising dollar. Germany's 10-year bond yield, meanwhile, hit 2.57% per annum, the highest borrowing cost for Berlin since July, and 0.4 points higher from this time last year, as the euro dropped within 2.5 cents of parity, its lowest dollar exchange rate since November 2022. With 1 week until Donald Trump returns to the White House, Washington's 10-year borrowing costs hit 14-month highs above 4.70% per annum after the December non-farm payrolls report. Tokyo's 10-year rates rose to 2011 levels, above 1.20% per annum on Japanese government bonds, and Beijing's government borrowing costs also rose, with China's 30-year bond yields adding 0.1 percentage points from the New Year's fresh record low of 1.80% per annum. Shanghai's CSI 300 share index meantime fell hard, down 1.3% for the day to its lowest since the communist government promised economic stimulus in late September to try stalling the world number 2 economy's slowdown in growth. Today's move put the CSI 300 back at a level first reached in the spring of 2007. Industrial commodities rose again in contrast, taking Brent crude to 3-month highs above $80 per barrel, as London copper broke above $9,000 per ton for the first time since November. Semi-industrial precious metal silver also outpaced gold's gain for the week, adding 2.6% in dollar terms after hitting a 3.5-week high of $30.60 per troy ounce following the US jobs news. Please like this video and subscribe to our channel.